Hello friends, welcome to this discussion on monetary policy which was announced on 7th of June 2024. All of us know very well that the repo rate has been kept at 6.5% for the 8th time in succession, and the stance of the monetary policy continues to stay focused on withdrawal of accommodation. These two aspects remains the same, but what is more important is looking to the strong growth of the economy and the resilience that has been built up. The forward outlook for the GDP growth has been increased from 7% to 7.2% for FY25. And the inflation outlook remains at 4.5%. RBI is very candid that the status quo of the repo rate, that is elevated rates for longer duration of time, will continue until the inflation comes to 4% mark on a durable basis. And the biggest risk, while the core inflation is coming down, the biggest risk for the inflation to come down to the 4% is the food inflation, which is going to be a very hard nut to crack. But one good feature in the coming southwest monsoon is going to be above the normal, that is 106% of the average. So it's going to be good. So there will be some kind of stability as far as the farm sector is concerned, and it is going to flow back into the stability of the inflation. So it is expected that maybe in the next 2 quarters the inflation may come down to, of course RBI has already forecasted 3.8% in Q2, that is September ending, as far as the inflation is concerned. And now when we look at the external sector, many of the countries have already started reducing the interest rate, and the most important significant change has been by the European Central Bank, that is ECB, has brought down the interest rate by 25 basis points. So that is one important external sector development that could prompt UK to bring down the interest rate, and maybe subsequently the Federal Reserve, which is facing the last mile disinflation process to reach the 2% mark. I think it's going to work out. So let's wait for that to happen. And RBI is very candid that though we will be very much watchful about what is happening in the external sector, but our trajectory of interest rates will continue to be focused on the developments in the domestic sector, and that is also right. But the one important point that I would like to highlight in this discussion is the structural liquidity mismatches that the banks are facing for the last 1.5 years, and it is going to remain so for longer duration of time, because the pattern of domestic savings itself has undergone a change for the last 2 to 3 years, and it is going to be so in future. The average age of Indian is 28 years in 2021, so we are the youngest economy as far as the demographic profile is concerned. So with young people with good knowledge and financial literacy, there may be some structural shift of savings from the traditional banking system to non-banks, which are able to offer a better risk-adjusted return in the perception of the investors. Now the perception of the investor is very important as to what they are looking for. So in this kind of a situation, when the pattern of savings is shifted from the banking system to the non-banking system, so the savings may come down further, as it is growth rate of credit is higher than the deposit growth. And if this trend continues for a longer duration of time, the banks will be facing huge liquidity risks. And as far as the frictional liquidity is concerned, that is a very short duration, instant liquidity problems that can be met by market borrowings or by using the tools of liquidity adjustment facility of RBI. They can borrow from MSF, that is a marginal standing facility. They can borrow from the market, from the interbank call money market. They can also subscribe for the VRR auctions of the RBI. So and they can also, of course, for deployment purpose, they can use standing deposit facility. So the small duration mismatches can be met. But when we look at the long-term perspectives of structural liquidity mismatches that can prop up in the banking system, I think RBI has already alerted the banking system that they need to re-strategize and work out different business models which will be working in the current kind of situation, because the savings of the people are gradually shifting to non-financial savings, that is on the real estate, gold and others, and whatever the financial savings are there, they are also flowing to mutual funds, insurance and NBFC deposits, and also the stock markets, and which are very bullish, and they are able to give better return to the customers. So looking to all these perspectives, the tendency of the savings to shift to alternate sources are visibly very important for the banks to understand the nuances, and hence it calls for modifying the business models of the banks by making the line management understand the oncoming risks to the banking system. So they need to re-strategize and also focus on very granular focus on asset liability management and the data that flows from the operations to the ALM, that is the Asset Liability Management Committee, and also the peer group and the market intelligence data and the macroeconomic intelligence data. All these things will have to be put together, and a lot of research also has to be conducted to understand the perception of the customers as to what kind of features they would like to see in the banking deposits. And one more thing which I would like to highlight here, all the NBFCs can be banks customers. So when the funds flow from the banks to these non-bank financial entities, they can also be procured, and that is the reason why RBI has in this edition has increased the size of the bulk deposit from 2 crores to 3 crores. So I think a lot of interest rate variations can be done, CPs can be used, and a lot of other tools can be explored. But at the basic point, what is more important is to continue to find ways and means of attracting the deposits first to the banking system, then they may pass on naturally to the non-bank financial entities. But when we grab the deposits of non-banking financial entities, I think something flow back will come into the banking system. That aspect has to be kept in mind while working out the strategies, and also the bulk deposit, mix of bulk deposits and pricing the liabilities and also assets, because when we are lending, then these costing has to be factored into that. So I think a lot of mind application will be required for managing the asset liability mismatches, and also in pricing the assets and liabilities, and also carving out the mix of assets and liabilities. And then I think the banks will have to go for more of risk deciphering. We will have to decipher the risk appropriately, create simulated environments, different kinds of business environments, and then do that stress testing and back testing and see that they are as appropriate as possible in finding out the price discovery for the assets and liabilities, so that they can continue to protect their margins. And one good thing in the post-COVID environment, banks have done exceedingly well. They are very robust in terms of capital adequacy ratio. Their NPAs have come down to 2.8%. Their net NPAs have come down to 0.8%. I think this kind of a strength of the banking system on one side and the strength of the corporate sector on the other side has not evolved in the recent past. So we are very strong on both sides. That is, a twin balance sheet problem has now turned into a twin balance sheet advantage for the financial sector. I think banks will have to redo their business strategies too. And this monetary policy, why I brought this policy is, this has very clearly given the signal to the banking system that you will have to do something on the business model, on the business strategies and pursuing them, and then how to calibrate them and how to implement and see that desired change in the assets and liabilities do happen, so that banks are not overexposed to the liquidity risks. And liquidity risks, if they are overexposed, then the financial stability also comes into problem. So we will have to look at that. So looking at all these aspects, maybe the problem of higher interest rates, inflation coming down to 4%, GDP going up further, all these things will work their way in the coming years. But what is more important for banks is their task is very much cut out, that they need to focus on asset liability management, and if they do that, I think they will be able to contribute to the growth of the economy, because it's very much essential that the flow of credit is continued, and this is the time when the entrepreneurs can tap the potential of the economy. And at this point of time, the bank should not dither in lending to the different sectors of the economy, but then they will have to match the assets and liabilities and the pricing equation, so that they can do much better than what they were doing, and their strength which they have now got, they are able to retain it for a longer duration of time in the coming times. This strength which they have now acquired must be preserved, protected, and they should flow back to make the lending happen the way it is required by the economy. So we will again meet in the coming episodes of discussions, and we will meet again. Please subscribe for the channel and also share with your friends. Put your comments and your views, so that we will be able to improve our delivery and our inputs in the coming videos. And till then, thank you very much, and have great time.